East African integration moved ahead slightly on Tuesday following a three-way meeting of the heads of state in Entebbe, Uganda. At that event, plans to ease trade and to speed up the pace of integration were agreed to by the Kenyan President Uhuru Kenyatta, his Rwandan counterpart Paul Kagame and Uganda's Yoweri Museveni. Now, among other things, the trio agreed to invest heavily in two oil pipelines, one of which will allow South Sudan to bypass her neighbor to the north, and a regional railway network as well. With the details from Uganda, here's CCTV's Isabel Nakeria.
The three East African heads of state have agreed to strengthen cooperation in the region by removing all trade barriers. In a communique signed by Paul Kagame of Rwanda, Kenya's Uhuru Kenyatta and President Museveni, it was decided that goods will be cleared much faster at the Mombasa port to reduce congestion and delay. Uganda's President Yoweri Museveni and chair of the East African community says he wants to see a large reduction in the number of days this takes.
All those trade barriers will be removed, and that's why you hear that we want to make East Africa one customs area, which means the paperwork will be done in Mombasa, for instance, and the vehicles will just drive non-stop.
The East African states will also develop an oil pipeline from Eldoret in Kenya, which will link Uganda and Rwanda, and another connecting to South Sudan. Uganda and Kenya have recently discovered oil and estimate they will be able to extract thousands of barrels each. Uganda's Foreign Affairs Minister Sam Kutesa says the country should now invest in a refinery.
It was agreed that we develop two oil pipelines. One pipeline that currently exists and brings product from Mombasa to Eldoret. It will be extended to Kampala and to Rwanda. Another pipeline for evacuation of crude oil when it starts flowing. This again will be done between Uganda, Southern Sudan, and Kenya, ending up in the port of Lamu.
The heads of state also agreed to revamp the railway lines to create a link-up within the partner states in the region, establish East African identity cards and work on generating electricity. Uganda, as the chair of the East African community, says this will help fast-track the integration process in the region. The decision to have free trade within the East African states is hoped will ease flow of goods and services and likely strengthen cooperation within the regional states. Isabel Nakiria, CCTV, Entebbe, Central Uganda.
Now, despite stellar economic growth rates, the quality of governance across Africa is in decline. That's one key conclusion from the latest edition of the World Bank's Country Policy and Institutional Assessment Report. Between 2007 and 2012, policies aimed at making it easier to do business and, by extension, trim poverty have remained relatively stable. In contrast, though, the quality of governance has declined last year to return to levels last seen 4 years before that. And that in turn leads to two questions. What's CPIA and why does it matter to you? Well, CPI essentially tracks a country's policies and implementation in economic management, structural policy, social inclusion and equity, and public sector management. And it scores countries on a range of 1 to 6. Now, in 2012, the World Bank data indicates that 11 African countries improved, or rose rather, by 0.1 points or more, reflecting in effect better policies coming through and being implemented. On the other hand, however, 12 countries posted a decline. And if you look at this even further, Cape Verde and Kenya are right at the top of that list. But keep in mind, for Cape Verde, despite being at the top, this was the third consecutive year of decline altogether. Kenya, for example, did successfully avoid a spending binge around its elections in March this year, compared, say, to Ghana, which unfortunately did not. That, however, didn't stop Ghana from being among the other top performers on the continent, alongside Burkina Faso, Rwanda, Senegal and Tanzania. Those two countries, of course, getting quite a bit of attention so far this week. Flip side of that entire scale, countries grappling with deep social and economic challenges. So the names here, quite frankly, aren't surprising. South Sudan and Eritrea, right alongside the likes of Zimbabwe, Sudan and Chad, all of which, incidentally, were well below the sub-Saharan average of 3.2. Back to the fundamental question, why should any of these numbers really matter to you? Well, since 1980, CPIA has been used to determine the allocation of zero-interest financing for countries through the World Bank Group's Fund for the World's Poorest Nations. It also gives individual citizens the information they need to hold their governments to account on various aspects of public policy. Now, of today's data from the World Bank, trends in policies aimed at cutting poverty, making government operations more efficient and better managing public resources indicate that sub-Saharan Africa's 13 commodity producers are lagging behind their 26 counterparts whose economies are largely dependent on agriculture. So why is that the case, and what really can be done to change it? That's a question I put to the World Bank's lead economist for Africa earlier today.
That's why it's very important to have more transparency regarding what the actual amount that's collected and then how it is being spent, so that citizens are more informed about what is the size of resource wealth, what are the revenues associated with it, where is it going, what kinds of investments, and are the government's priorities aligned with the priorities of the common person or the poor people, and is it helping to reduce poverty? We find in the context of Africa as a whole that growth has been less poverty reducing than in other parts of the world. So if you looked at, say, a resource-rich country in Africa and one in say, East Asia or other part of the world, the same amount of growth would translate into larger poverty reduction elsewhere.
International ratings agency Moody's says the economic outlook for sub-Saharan Africa is positive, but it's still exposed by overdependence on commodity exports and susceptibility to event risks. Now, lack of diversification and the resulting exposure to external shocks, be it from oil or financial issues, dents the region's productivity and growth potential, as the continent is yet to build up an adequate buffer of savings. Now, the service notes that exports in the region are concentrated in the petroleum and mineral and metal ore products that account for over 75% of exports in 2011. Botswana is highest rated in sub-Saharan Africa at A2 with a stable outlook, followed by Mauritius and South Africa at Baa1 with stable and negative outlooks, respectively. Nigeria is rated Ba3 with a stable outlook. Ghana, Kenya and Senegal are rated at B1, all with a stable outlook. Now, Kenya, of course, is betting on a good rating and favourable market conditions to launch a $1 billion Eurobond later in the third quarter of 2013.
Ratings are long-term and forward-looking in nature, so we wouldn't expect to see a ratings change so soon after the rating was first assigned. And in particular, we have a stable outlook. Had we assigned the rating with a positive outlook, you might see a change as soon as within the first year of its being assigned.
Meanwhile, in South Africa, the country's Competition Commission has fined many of the larger construction companies there for what it described as collusive business conduct. 15 companies are fined a total of $140 million, though at least one business group is upset, arguing that the fines simply weren't enough. It also appears that one important player, the consultants in these deals in the sector, were not investigated as well, and that's something the Black Business Council in South Africa has asked the country's crime-fighting unit, the Hawks, to investigate.
What we are really calling for is for government, state-owned enterprises, public, to take the stringent action against people that we believe colluded to keep new entrants out of the market. It's basically saying these people were corrupt in their practices.
In terms of the strict definition of collusion, and this is derived from the Act itself, the activities of the consultants do not constitute collusion. However, they do constitute fraudulent as well as corrupt conduct, which then will be the realm of the Hawks, not the Competition Commission.
We're fast closing in on 17:45 GMT. Time for a short break on BizAfrica. Here's what's coming up next. China and the Seychelles are marking 37 years of diplomatic ties with a range of initiatives, including a visa waiver program. I'll be delving into that in depth when we come back. Welcome back. The Broadcast, Film and Music Africa Conference is currently underway in the Kenyan capital, Nairobi. It's one of the largest annual gatherings of electronic media content creation and distribution professionals in sub-Saharan Africa. With over 800 delegates and 130 speakers on the roster, it's billed as the one place where regional and international industry experts can share their latest insights and development trends in the industry. Now, also on the program is a second Africa Media Business Exchange. That's a platform for media startups on the continent to pitch their business ideas and opportunities to venture capitalists and other potential investors, as well as for content producers to pitch their ideas to commissioning editors and other buyers of content. Russell Southwood is the Chief Executive Officer of Balancing Act, a research firm focused on telecoms, internet and broadcast in Africa. He's taking part in the conference and is joining us right now live in studio. Mr. Southwood, thank you so much for your time this evening. Now, at the start of the conference, iTech Africa's chairman fired a salvo, quite literally, at imported programming, saying, and I quote, "The era of cheap imported soaps will soon be over." What market forces are driving that trend?
You've got a choice between buying international programs, particularly telenovelas, which are the Spanish, Latin American programs that are dubbed into whatever language they go to in the world. And these cost somewhere between $200 to $500 an hour. And you compare that with, say, something between $10,000 to $15,000 an hour for programs commissioned locally in particular African countries. And for the people who run the broadcast stations, that is in many ways a no-brainer. So that's the market constraint. However, it's worth saying that the stations like Citizen TV in Kenya have used local content very effectively to go from number 4 to number 1 in the marketplace.
Is a combination of these fast-growing access to mobile devices, internet access as well, plus video-on-demand services like Roku TV over in Nigeria and of course niche channels on YouTube, could that perhaps be the Trojan horse as well that might break that market pattern as well?
I think it's too early to say that it would, in a sense, fundamentally alter the model. But what it does do is it eats away at the traditional broadcast market. So you have in Nigeria something like 6.7 million Facebook users. And these are all people who are regularly on Facebook and will probably be using Facebook to comment on television programs, to understand what they want to watch, to have things recommended for them. So it begins to affect how television is viewed.
Isn't the weak enforcement of intellectual property laws really the weak link here? Isn't that another key limiter to the uptake of local content here?
I think the difficulty in talking about pirate markets, which is what you're referring to, is that everybody in Africa uses them. Or almost everybody knows that there is a shop where they can buy pirate DVDs. In Kenya, there'd be 50 shillings or so. And actually, what the pirate markets demonstrate is that there is a market for content that people will pay money for. It's just not the same amount of money that the rights holders would like to get from that market. So I think the issue, or the challenge, if you will, for the people trying to distribute that content is to provide it at a price that people will be able to afford and in a form that they will be able to afford. Now, the new technologies like mobile and tablets allow you to stream that online, which means that you have some greater degree of control over the intellectual property rights. So maybe there is some protections will come with that and the market will change in some ways.
Finally, Mr. Southwood, does the fact that you've got your mobile platform as your first point of contact for a lot of electronic media content in Africa, how does that fundamentally change the business model for selling and consuming media in Africa?
I think the big change will be the introduction of 4G, which is also known as LTE, and that is happening at the moment. There's about half a dozen implementations on the continent, and there will be maybe a dozen by the end of this year. And when this new 4G comes online and the speeds are much faster, the existing people who are running it are discovering that people are using video, surprise, surprise. And this is because video will probably be the use that is, in a sense, the major use. Now, the difficulty is then constructing a business model out of that. How do you get money out of people for viewing that content? And that's the big challenge. And we're yet to see how that will play out.
Interesting times indeed. Thank you very much for your time this evening. Russell Southwood, Chief Executive Officer of Balancing Act. Right, moving away from matters media in Africa. 2013 marks the 37th anniversary of diplomatic ties between China and the Seychelles. Now, the two countries are celebrating that milestone with the launch of a visa exemption program for Chinese tourists visiting the Seychelles, effective on Thursday. The country is also building an offshore trade hub, bringing access for Chinese businesses to the Middle East, the rest of continental Africa and Europe as well. Laura Luo reports.
The Seychelles is a traveler's heaven in the middle of the Indian Ocean. It's not only known for its breathtaking beaches, the rich resources, but also its luxurious holiday services. Now, this dream holiday destination is within easy reach for both Chinese tourists and businesses, as they don't need an entry visa anymore. China and the Seychelles signed bilateral agreement in May to allow their residents to enter each other's border and stay for no more than 30 days. Its chief trade representative, Mr. James Quincy Liao, says this opens new doors for Chinese businesses eyeing opportunities in the Middle East and Europe.
It's convenient for bilateral trade, especially Chinese firms, to use the Seychelles as a transportation pit stop in the Indian Ocean. It can conduct trade on large scale through a platform like the Seychelles to Africa, Middle East, and Europe. The Seychelles and nearby countries have over 800 million people. The consumption power of these people is huge.
Mr. Liao also says the island is aiming to become a financial hub where foreign companies can enjoy tax benefits.
Business from different countries can use the Seychelles as a platform for trade and deal with finance and capital operation, as well as funds management for family businesses. There are about 20 to 30,000 offshore companies in Seychelles, and we hope this number can reach 50,000. We will serve these companies according to international laws.
The country is also stepping up its infrastructure to facilitate foreign companies to establish branches on the island. It has recently opened 3 weekly flights between the island and Hong Kong this June and has already seen a 67% hike of tourists compared to last year. With the new visa exemption coming into play, China is set to become an increasingly important market for the island. Laura, CCTV.
Just before we talk about the Rugby World Cup, at least as far as the sevens are concerned, let's make a quick run through the markets. Bit of a mixed bag across the board, depending on which markets you're talking about. However, the trends really are still very much in force. The Nigerian all-share still on that downward plunge since around middle of June, give or take, around June 11th. The all-share index in South Africa up by 0.2 on the day. The 20-share index in Nairobi, again, closing the day lower. The bear run still very much in force over there. And the Egyptian market ending the day higher by just over 0.2%.